Michael Gallo from Valerisys Consulting. Mike will present for about 45 minutes or so, and at the end, there will be a Q&A session. On your screen to the right-hand side, you will see a chat box. That is where you can enter your questions, and we can answer them either as we go along. Mike will decide, or he might stop at the end and start answering the chat box questions. There should be no need for you to speak or no need for you to have to mute your sound. Further ado, I'll present to you Michael Gallo, founder of Valerisys Consulting, which is located in the DC metro area. And Valerisys specializes in advocates the use of top-down metric analytical approaches to improve decisions in pricing, biz capture, budgeting, and project planning. Mike took his insights and expertise from his 20 years of experience conducting data collection and research, the complex parametric pricing and budgeting forecasts, providing analytical insights to senior decision-making clients in the Department of Defense. Many clients were responsible for large, multi-billion-dollar capital investments and program acquisition decisions. It uses a multidisciplinary approach that on concepts, theories, and techniques from accounting, finance, economics, operations research, statistics, engineering, and management science to provide unique value-added decision support services to his clients. So without further ado, I will invite you to listen to our webinar today. Here is Michael Gallo.
Everyone, to today's webinar on proposal pricing strategies, and let me wish everyone a happy Valentine's Day. Before, let me say that today's seminar is intended to provide you with some basic concepts, advice, and strategies for pricing your contracts. It's not intended to provide specific guidance on compliance with federal acquisition regulation or the FAR. So with that said, let's get started. There's an array of items to consider in your portfolio pricing strategy to cover pricing approaches, price components, price strategies, some good price practices, and finally some winning tips. By the end of this webinar, I hope you gain some useful insights on your proposal pricing strategies to help you win, profit, and perform on your next contract bid. Objective of pricing strategy. Our main objective is to set a price that motivates our buyer to buy. But there are more objectives to consider in your pricing strategy. Not only does your price have to be low enough to cause the buyer to buy, it has to be low enough to ensure that the customer chooses you over the competition. But you can't go low, or else you won't recoup your costs. And what about profit? As we'll see in a bit, you need to be thinking beforehand about how pricing affects our profit, and we'll talk about that. Finally, our pricing strategy must address uncertainty, or else we run the risk of poor performance on our contracts and possibly the risk of significant loss of both business and income. Not every strategy we'll review today will address all three areas at the same time. Some of our strategies can only address one, like our increasing our ability to win. That you can't focus on just one single strategy. You have to take a more comprehensive approach. There's one way to approach pricing, but for contracts, the build-up approach is going to be the dominant one, and we'll discuss that in a little bit more detail. We'll touch really quick on the others. One pricing approaches let buyers influence the price of the transaction. Buyers bid up the price in order to win the right to purchase our product. Work on the principle of auctions. That pricing really reflects the combination of the seller's understanding of the buyer's perception of value. It's an example of value-based pricing might be contracts for billing, auditing, buyer's billing system. The contract would be set on the negotiated percentage of savings that the seller achieves through analysis of the buyer's billing data. Based approaches are based on the price that other sellers are offering to sell the same item in the market. You have to be careful. Pricing can become disconnected from your costs and become irrational. So when somebody's entering price wars like the airline industry, we're seeing market-based pricing in action that can be destructive to businesses. That's the advantage of our final approach, and we'll spend a little bit more time on that, and that's the we price as the simple buildup of 3 high-level pieces: direct costs, indirect costs, and profit. For anyone here today that's new to the federal government marketplace, the notion of thinking of profit as a component of your price might seem a little backwards. So if you're used to establishing your price in the market to penetrate the market, and then how to minimize your cost over time to maximize your profit. That type of approach. Last, as you listen to the presentation, that you open your mind a little and consider profit as another element of your price as we review each of our price components individually. Our component is direct costs. Everything you can attribute to a specific product or service. You get on a project for professional services, for example, your direct costs would be your project staff wages, some of all of your project manager's wages, and any expenses that are directly applicable to the project, such as travel expenses to give a presentation to the client. In an environment, your direct costs would include factory labor needed to assemble the product and the product's bill of material. Typically, if the cost can be substantially attributed to a product or service, it's considered a direct cost. Second price component, indirect costs, can't be tied to specific products and services because these costs are shared. I put direct costs into 3 broad categories: fixed, variable, and what I call discretionary. Indirect costs are those costs that don't change over time as the volume of business increases. So for your rent costs, example, something that doesn't change dramatically as 1 or 2 new employees are added to the organization. Depreciation, insurance costs, and other management, general management salaries would be other forms of fixed indirect costs. Your variable indirect costs do change somewhat with the volume of your business. So employee benefits would be an example of a variable indirect cost. Generally, bringing on more business volume means you got to hire more people, which means the company has to pay more for company-paid benefits. Finally, the third category, discretionary indirect costs, are costs that reflect priorities of your business plan. Costs you can think of related to management decisions to execute that plan. So an example there would be bonus or incentive compensation. Let's talk about our final price component, profit, which we can 2 ways. The prevalent way is to think of price as an output, as a byproduct of your business performance. You can also view product as an input into pricing strategy. If we want to look at it that way, the reason is because it's such a critical component to your overall business in terms of what the business needs in order to succeed. And I've listed some examples here of use of profit. So with those uses of profit, it's not too hard to see that getting more of it is better for growing, improving, and protecting your business. Summarized, the build-up approach to pricing allows us to set our price based on rational build-up of direct costs, indirect costs, and profit as an input. Okay, now that we've briefly reviewed components of price, let's talk about components of pricing strategy. Our first area are pricing factors. And there are many factors that will influence a price bid. The common theme is that they really address the issue of understanding how we can get our price down in order to win. And there are 8 factors you can consider, and we can't possibly cover them all in this short session today. Touch on a couple. First, for most companies, labor-related expenses are the largest portion of their indirect and direct costs. So change is the position of your labor and decisions you make on policies related to compensating employees are going to have a big effect on your price. So, for example, pay raises, promotions, change in your benefit policies, those will all affect ultimately your price. And how attrition, staff turnover, and recruiting, training, and productivity costs are going to creep into your indirect cost structure. Some consideration you may be making is make versus buy or insourcing versus outsourcing decisions. And be asking the question, is it less expensive to have another business provide a key part or service, or does it make more sense for your business to train production of a part or delivery versus in-house? Those can affect your price. And let's jump down to the last factor, which is obvious, is just straight out discount on your price to lower it overall. When you count, you're essentially reducing your overall profit margin to your price low enough to put you in a position to win the bid. All those are related to bringing the price to get you in a better position to make your bid winnable. Our second area strategy really addresses how to ensure our pricing keeps us profitable. I want a little bit more about this issue. I mentioned in the previous slide the issue of business uncertainty and having profit to help us over the ebbs and flows of business. If you think about this a little bit, your pricing strategy has a lot of assumptions built into it. Those assumptions are based on business forecasts. The forecasts are never perfect. They're a prediction of the future. This is in kind of the chicken or the egg dilemma. You have to have people, materials, and resources to provide the goods and services, and that costs money. But you need to know how much business you think you'll generate over the course of the year. Then your pricing strategy is a balance between your forecast of the costs of your services and an estimate of the revenues you'll generate over time, like a fiscal year. So forecasting model of your business direct and indirect costs is useful to help you organize, analyze, and understand how a company transforms resources into revenue and income. Even I did this as a CFO. These models are essential to help you determine your break-even points and that's how much risk you might be taking in pricing, especially when you're setting your indirect rates. Third area of pricing strategy that I've shared with you today is all about risk. Think how are you addressing risk in your bid? Are you even addressing it? And I've broken this down into several different categories to give an idea of perhaps maybe the spectrum of risk that you might encounter in your next project bid. And when we think about those, we want to build in reserves and contingencies and plan for the possibility of encountering things that were possibly unknown at the beginning of our project, but nonetheless will affect our overall project performance. So reserves and contingencies are certainly one way we can basically buy ourselves insurance in our pricing in order to assure not only ourselves but our clients that we're giving them is ultimately going to be executable. So rating, from my perspective, is all about performance. It's the third arm of strategy. Sound pricing practices, and I hope you're beginning to see that there's a lot of analyzing and forecasting and modeling that you could do to better understand and improve the results of your pricing strategy. First practice, I recommend you harvest your past performance. Don't blindly rely on hunches or rules of thumb your pricing approaches. Yes, if you've been in business for a while, I'm sure business owners have a sense of the resources needed to do the job, and you're probably pretty good at it. But you should harvest your accounting, project engineering, and other data that generated and execute your contracts and projects, and use data as a means to develop sound pricing that's based on actual performance. You backs up and confirms your rule of thumb. Now, two good reasons why you should do this. First, what happens if you're not there to put the price quote together and someone on staff has to? Or your staff's rules of thumb as your rules of thumb. Maybe they are, maybe they're not. Two, collecting and using your own data is a great way to perform a check on your pricing strategy. You can basically ask the question, how low can you safely go and still get the job done? The benefit of harvesting your past performance data is that you could use it to better understand how changes in your offerings as you evolve over time will affect the ultimate change in your pricing and your offerings. Collecting past performance data, you can also compare your actual performance to or estimating and expecting when the contract started. Feed that information to improve both your forecasting capability and your ability to plan and anticipate risk and uncertainty. Point in your business's life cycle, you will have a contract that's much larger than anything you've undertaken before. You're going to demonstrate to the client that you understand the resources needed, and how are you going to demonstrate that your pricing has adequately considered risk, so the client has confidence that you can undertake this much larger bid. Hardening your past performance can help. Doing it today. Pricing practice to consider is formalizing and standardizing your pricing strategy in a pricing model. To keep you organized, it can help you produce a consistent and objective price quote. The model doesn't have to be expensive. Start with a simple Excel model and then build it up over time, and perhaps migrate to a more sophisticated or commercial tool. The two most important parts of your model are your own underlying past performance data that we just discussed, and your knowledge that you possess about your business's products, services, and operations. And the more your knowledge and data that you can put to that pricing tool, the better the tool is going to perform for you. Pricing model will also perform better over time if you continue to feed it your performance data as you complete your projects. I recommend you get in the habit of documenting your pricing assumptions. If you're not doing it now, I recommend that you do. And why is that a good recommendation? When the customer pushes back on your pricing, you'll have the ability to intelligently discuss the assumptions that you made in your pricing. And by planning and discussing those assumptions, both your business and the buyer shift the discussion to one of clarifying those assumptions and pricing trade-offs. So when the buyer thinks the price is too high, you can view assumptions and jointly uncover areas where the buyer is willing to perhaps relax a requirement to get a lower price. And I mentioned, as you graduate into larger federal contracts, it becomes increasingly important for the government to understand how you arrived at your price, and you'll have to show them documentation on assumptions and methodologies that you use to arrive at your price bid. So get started on that, the more proficient you'll be when it becomes really important for you to demonstrate your understanding of your pricing. We're the home stretch here of the presentation. So let's discuss a couple of winning pricing tips. The first might not always be possible in federal contracting, but using pricing options as a way to give your buyer a range to help understand value. It makes some of the guesswork for you out of the bidding if you can do it. Your depot store, how they sell their products. They always categorize the products into good, better, and best. People trying to help you, the buyer, understand the things that differentiate value and price, and then based on that, you make the decision about what level of value you would like to invest in to reap those values and benefits. It's sometimes hard to do in arm's length government contracting. It is to question requirements, especially if they look what I would call quote-unquote gold-plated. Use that term gold-plated to describe requirements that are expensive to fully satisfy over an alternative scenario where the offering doesn't satisfy the requirement. It would be significantly less costly to the client. Now, sometimes high level of need is absolutely necessary for the federal buyer. At times it's not, and the customer might save a lot of money if they would be willing to relax the requirement. So opportunities to question requirements, respond to requests for information if they float a draft statement of work or performance work statement, comment on it, and provide that feedback. Topic items should be obvious. We do have to consider our competitors' pricing behavior in our own pricing strategy. I have separate thoughts here on approach, which refer to as price to win. First, the federal government is becoming more transparent with its contracts and purchases. So a lot of information on basic contract award values now available on the internet for free. Resource to check out is usaspending.gov, all one word. You get a lot of good information on prime contracts awarded by the federal government, and also added information on subcontract awards as well. You can learn a lot about your competitors' labor pricing and structure by analyzing their GSA contract information if they have GSA contracts. So visit usa.gov, pull your competitors' pricing schedules, and learn about your competitors' advertised time and material billing rates by reviewing their contract labor schedules. I mentioned this issue of price to win services. A price provides non-advocate assessments of the competitive likely behavior. It's designed to help you determine a target range of your competitor's bid. On that information, you can determine what your price needs to be in order to come under that expected competitive range and win the contract. It's a strategy to help you win the work with caution that you usually employing some form of market-based pricing when you do price to win, and you run risk disconnecting the price that you're coming up with to win the work with the reality of your underlying cost structure. So be very careful if you're using that approach to win contracts. Let's briefly summarize how pricing factors and pricing strategies impact our ability to win, profit, and perform. Weekly about some pricing factors. We talked about risk. We talked about discounts. We didn't go over the benefits that you might have if you have repeated processes or implementing process improvement, things that reduce your cost to provide that good services to your client that you can do then to turn around and pass on those savings to your client in the form of a lower price. That's going to help you win and increase your chances to win. If you're passing on those savings, you're also passing on the opportunity of increased profits. So trade-off there when you do that. So when we talk about incorporating risk into our pricing bid, we'll certainly increase your ability to perform, and to increase your profit in the sense that accounting for the possibility of risk and uncertainty in your profit is going to help you avoid costly losses. It may not increase your chances of winning the bid. I would comment there that if you're doing a good job looking at your risk and uncertainty and building that into your plan, you're probably going to submit a proposal that has a much stronger technical approach. So you, in fact, actually be increasing your chances of winning the contract as well by addressing risk. With discounting, you're going to increase chances of winning. The customer certainly is going to like the lower price, but certainly not going to be doing any favors to your bottom line because you're essentially reducing your overall profit margin when you discount. Practices and strategies. Assessing your data, using a pricing model, and documenting assumptions, I believe really will help you in all three areas to win, profit, and perform. As I discussed previously with the price to win strategy, it's certainly going to hopefully put you in a better position to come under your competitor's bid. It can be really dangerous if that ultimate price you're submitting is disconnected from the reality of your underlying cost structure. We didn't talk about in the presentation was using a standard bidding structure. Standard workdown structure perhaps, or other standard structures that you can use from one bid to the next. It's very helpful to increase the quality of your pricing, certainly the comparability if you compare one bid to the next. And if you're using those same structures to actually plan and execute your projects, you're in an excellent position to have a very homogeneous data set that you can then use to analyze and feed into your pricing model, which, if that's incorporating the standard pricing structure, really allows you to produce consistent bids very quickly. The final thing I would say is if you're going to use to win strategies as a key strategy to win work, I highly recommend you go ahead and harvest your past performance data and look at using top-level safety checks to make sure you're comfortable with at a top level how your projects have come out in terms of price and actual resources needed over time. Compare the sanity check against what you're coming up with your price to win, and make sure you're comfortable with the answer that's coming out of that comparison. Finally, we're on our last slide. Let me leave you with a parting thought. There's one magic answer for ensuring pricing success, but let me give you a recipe that to be successful, do two things at the same time. First, set a price for your goods and services that's greater than your costs. That should be obvious. Simultaneously, you have to make sure that the value of what you offer your customer is greater than the price you want to charge your customer. Now, sellers are in control of both your price and ultimately the cost to deliver the good services. However, it's the customer, the client, who will determine value. Value is whatever the customer perceives to be of importance. So to win the sale, customers must perceive that the value of your offering is greater than the price that they're paying. You get P just right, and you're on the way to winning, profiting, and performing. Time we have for today. Thanks for attending the presentation. And with that, let me hand the mic back over to Mindy and see if there's any questions.
So, can everyone hear me?
I hear you.
Okay, so thank you very much, Mike, for your presentation. I'm trying to find any of the questions to the right. Do you see some on your screen?
You can see a couple. Let's see. I'm just going to raise my volume up here.
Better? Can everyone hear me now?
I can hear. Yes, that's very clear.
Not Q&A questions in the box. Do you have any?
I'm not any. I'm just looking in the general chat box.
Jesse or Jess Turner has a question. Go ahead.
Okay.
You can type it in the box, please. The chance to type in their questions, and we have one here, Mike. See here, this person has a boss who seems to win very few bids. Maybe it's who at that point is. I think you maybe need to give us a little more information.
Yeah. Let's go back to first, and then I'll answer Patty's. Old strategy is markup is too high. Yes, that's possible. I'd say if you're losing for a number of reasons, it's not necessarily true. Profit margin or your ask price is the sole reason you're not winning bids. I certainly would want to investigate and look at your debriefings from your other past proposal efforts and get a better understanding of the overall strength of the bid to see if significant pricing is driving the overall win. You want to also consider what's going on in your biz capture process and see how well are you qualifying your leads before you're getting to the point where you're bidding on your work. And if you've done that and you're still losing bids, then I think you do make a strong case that you really need to consider addressing unknown factors in your price and find ways to get it down. You could have a very inefficient process or a way of producing goods and services that's much more expensive than what other competitors in the market achieve. And you have a structural problem in your thing that you're going to need to address if you're going to win projects going forward.
Jessio has listed a question, what is a competitive or realistic markup? Because apparently you're getting information that there may be 20 to 50% higher. So can you address that a little bit, or is that something that's individual?
Well, certainly in the federal government, if you're bidding on what's known as reimbursable kind of contracts, you're already being capped at the markup, the profit they're going to put on your base of allowable costs. In the contracting where I came from, you typically did not see a markup of more than 10% on costs, and that's usually set by policy that you come at or under that. And depending on the nature of the contracts, you could see some very low markups. So, for example, old contracts in the Department of Energy see markups of as little as 2 to 3% of allowable costs. So, time and materials and fixed price contracts will tend to have higher margins. You might be in the 15 to 20% range for time and material contracts, and you'd be in the 25+% range for fixed price contracts because you're taking much more risks. So you have to build in those contingencies into your pricing and hope that you can mitigate them over the course execution and reap the benefit by lower costs. I would say, I guess, in looking at pricing strategies, you certainly could look at what's called your wrap rate, which compares your overall sell price as a ratio to your direct costs. And if you're a large contractor, your wrap rate is probably going to be a factor of anywhere from 1.9 to 2.5. And if you're significantly above that, then you probably have a structural problem in your pricing that you're going to need to address. If you're a smaller firm, you probably don't have wrap rates quite as high as that.
All right, let's go back to Patty's question. Can subs try with those control the bid?
Let me look at Patty's question. Can me with those controlling the bid? I think that the questions Patty, related to when you're controlling the bid, the prime contractor, and she has a discussion that the subcontractors are going to have with the prime at some point. Having that, typically the prime's already looking for your lowest and best price going in, your submission going into the prime contractor's pricing submission. And then typically I would expect additional negotiations occurring after contract award to see if you might be able to sharpen your pencil even more to actually get the share of the work and execute. I think if you're a strong subcontractor with in a unique position to offer value and increase the prime's chances of winning, you should be negotiating strong during that proposal stage. Adding something in writing in a strong position to protect your and pricing upon contract award. I hope that answered the question.
And we did get a message from Fred Woodward asking if we would receive a copy of the presentation. I believe that's been answered in that area, that yes, it will be posted on the BBI website.
Okay.
Post your questions right on the chat box. We'll be happy to answer them.
If a question, explain wrap rate formula again, Fred. Make sure. So let's say you offer looked at, again, the buildup of price, starting from direct labor, then applying indirect allocation of indirect costs, and then applying a fee, you end up with a price. Look at the ratio of either your offer price, or you can look at the ratio of the combination of direct and indirect costs in the numerator, and then denominator, your basically your direct costs. And when you divide those two numbers, either price or direct costs, you have what's referred to as a wrap rate, and it's a ratio, and it's a means to a rule of thumb to see if you're going to ultimately be in the ballpark. It's a way to say, if I have $100 of direct costs, is my ultimate sell price going to look like? I have to apply that $100 by that wrap rate, and I can instantly see what potentially my offer is going to be. Conversely, if you've got a pretty good beat on your competitor's wrap rate through good business intelligence analysis, if you look at their T&M schedules, you can use assumed wrap rates to back out the competitor's bill rates and kind of get a better grip on what their underlying cost structure might be on the direct side. That answers the question.
Thank you. We also have another question from Patty. If some pieces of your product do come from another country, as many do, is a deal breaker for awards?
I'm not in a position to answer that question. Certainly, there's foreign military sales rules, foreign export. Sounds like an import question, so I don't know if this is you might have a problem, which is like a Buy America issue. I'm not in a position to answer that question. I'm sorry, Patty.
Problem. Okay, I have another question here from Patrick Davis. What do you believe to be the greatest influence in the win contract? Would you say pricing or past performance, or a balance of both?
Ultimately, that's a good question today. I would have said balance of both. ultimately, I think it is about past performance. If you're executing well and you're harvesting and leveraging what you're experiencing in your project and applying those lessons going forward, I think you're not going to have a strong technical approach, but you're going to have a strong bid because you understand your underlying cost structure really well, and be able to put a really competitive price together. Now, that I think the budget environment we're entering today, it doesn't seem like there's more solicitations out there that are using this phrasing of lowest price technically acceptable. And the buyer is really communicating extreme trade-offs of value to price because our budget environment is becoming so austere. So we're looking at a situation where price to win really is going to become a significant force in the federal marketplace, and the potential for emitters lowballing bids to the government accepting them, that puts themselves in the position of having suffering from performance from contractors who didn't understand the resources necessary to execute the work. So in a situation, both parties are ultimately going to lose. The buyer's not going to get what they want. The seller's reputation is going to suffer go forward as a result of that lowball bid and not being able to execute.
I don't know if we have any other questions. Jesse, you put in PM with a question mark. Not sure what that means. If you can elaborate, feel free to. We'll give it another minute, Mike, to see if anyone else has questions. I really appreciate all the time you've left for questions because it's a great way for people to get involved. Okay, Jesse, your question is project manager with a question mark. I'm sure, Mike, do you understand what she's asking?
Could you just a question on acronym? PM could stand for project manager or program manager. I probably did somewhere in my slide and probably didn't make that clear.
Other questions? Let's see here. Does PM project manager
in
the slide earlier?
Yeah.
Okay.
Yeah, I think we got that.
30 seconds if anyone has something to ask from Mike.
Jesse?
Great session, Mike. I really appreciate your joining us, and thank everyone on the line for participating today. Another great added program from the BBI. I think everyone would agree that getting the information and also not having to leave your house today in the snow, with the snow out there, was pretty still, huh?
Yeah.
I just want to say thank you for participating. Thank Mike for preparing a great program for us today. And if anyone has any other questions, I'll take them now, or we'll, let's see here, just a couple thank yous. All right. Do you have anything else to add, Mike, other than Happy Valentine's Day?
No, I did see a couple of questions in other chat box. I'm not sure if I've addressed them or not. Let's take that question offline. If you could, my email information, contact information is on the last slide here. Please feel free to send me an email message if I haven't fully addressed your questions today, and I'd be happy to continue the conversation. Thank you.
Why don't you fill your contact information in case anyone has any other questions or would like to contact you?
I can be reached. My telephone number is 301-448-7578. Or reach me via email at michael.gallo, Gallo, at Valerisys, VALERISYS.com.
Perfect. Okay, just want to remind all the attendees today that there is a built-in survey that we would like for you to complete. And we appreciate your participating, and we need to make sure that we get information as to how the programs are received, what you think, what you'd like to see more of, or what we haven't given you yet. So please make sure to respond or let BBI know if there's any other webinar subs or series that would be of interest to this group. Thank you, Mike, and everyone else for participating. That's it. Thank you for joining.